All right. The next concept we're going to talk about is free cash flow to equity model, FCFE. Okay. Again, together with DDM, we are directly valuing the value of market value of equity. Okay, market value of equity. Now, how do we measure, okay, the potential dividends, right? Is an important thing, okay? Because why don't you measure the potential dividend or cash flow that is available to the equity holders by just using net income? Okay, why don't you use net income as your free cash flow proxy? Okay, is a valid concern, right? Now, here's the reason why. Okay, the accrual basis versus cash based. Okay, the accounting is a nice way of recording the history, but they are accrual based. Okay, the cash based is necessary, okay, for our financial analysis because cash is king, and then the present value of the future cash flow is what constitutes the present value of your company's equity, right? So cash based understanding is needed, whereas what is recorded in history with accounting report is just accrual based ones. For example, your depreciation and amortization kind of things, it is recorded as your expense and cost in your income statement, but those are not really your cash expense. Okay, you did not spend your cash to in that year, okay, as much as your dividend or amortization. Number two, your capital expenditure. Okay, capital expenditure. You already spent, okay, certain cash capital expenditure, huge amount in a lump sum way, okay, in a certain year, okay, but that is not recognized in your income statement. The capital expenditure does not affect your net income, right? Whereas it is spread out in the form of depreciation and amortization, and for matching principles, and then accrual based, right? So there's a mismatch between your actual cash transaction versus your actual recording, okay? That's a problem associated with it. So that's why we cannot just simply use net income as our proxy for cash flow, okay? So we have to do some adjustments, right? Some other analysts assume that earnings of a firm represents a potential dividends. This cannot be true for several reasons. Earnings are not cash flows since there are both non-cash revenues and expenses in the earnings calculation. Even if earnings were cash flows, a firm that paid its earnings out as dividend would not be investing in new assets and thus could not grow, right? And then valuation models, which where earnings are discounted back to the present, will overestimate the value of the equity in the firm. The potential dividends of a firm are the cash flow left over after the firm has made any investment it needs to make to create future growth and net debt repayments, right? Net debt repayments, what we mean by that is debt repayment minus new debt issuance, right? So value of equity in a complicated mathematical formula, oh my God, big sigma showed up, blah, blah, blah. Nah, it's just discounted and aggregating everything, okay? Now cash flows to equity, okay, should be the residual cash flows after meeting all operating expenses, tax, reinvestments, and debt obligations. So it is typically defined as net income plus depreciation minus capex, which is capital expenditure, and then change in non-cash working capital. We're going to talk about it, what the heck we mean by that, and plus due debt issued minus principal repayment, right? That is free cash flow to equity. This is the cash flow cash flow to available to equity holders. So after issuing new debt, after borrowing money from the bank. That's the cash flow available to equity holders. Okay, the bankers may say, don't say yummy, you shareholders, right? But the shareholders, literally, they can party on this borrowed money. I'm not suggesting you to do that because there's a lot of moral hazard going on. There could be, but that's the cash flow available to equity holders, right? Anyway, depreciation and amortization are added back because they are non-cash charges, right? And typically we bring depreciation and amortization from the cash flow statement. Okay, income statement also shows some depreciation and amortization, but I don't believe that. Okay, because this is affected by what? The accounting regulation about how to allocate the depreciation in a certain way or not. But the cash flow statement really states nicely about it. So I go for, if you have a choice, okay, I go for cash flow statements, depreciation and amortization amount. And then firms constantly reinvest cash flows from operations as capital expenditures to maintain the growth. CapEx, capital expenditure, right? Interchangeably I use it. CapEx, right? CapEx, right? What is that about? This is about your factories and your buildings and equipment, all these kind of storage spaces, right? That kind of things. CapEx is to support your long run sales, long run business, right? 10 years or 20 years down the road, okay? You need some factories or you need some buildings and all these kind of things. That's capital expenditure, very serious investment, right? CapEx should include dollars spent on acquisitions. So not just factory, but factory of your neighboring company that you are interested in. Yummy. Yep, take over that company. Takeover is another form of capital expenditure, right? You are just expanding your factory or R&D facility maybe, right? And this kind of things. Yes. And then increase in working capital ties up a firm's cash flow. The working capital, what do you mean by that, right? So this is essentially your inventory. The way I understand it about working capital is about your inventory to support your short-run sales, okay? Many students, I mean, when I was in your age too, working capital, I was confused, okay? Because in accounting, accounting, right? Gave some first-hand definition. The working capital equals current asset minus current liabilities. The current asset, which include cash over there, right? Minus current liabilities, which include all miscellaneous stuff that we are not interested in at all. So it gave me some wrong impression that working capital shouldn't the cash balance be in our working capital. No. Okay? Here is finance definition of working capital. It is very intuitive. This is about inventory. To support your sales. Okay? For example, let's say you are Zara. Okay? You are Zara. The clothing store. To sell your fast fashion clothes. What do you need? You need some stuff in the shelf, okay? You need some inventories on the shelf. That's working capital. To manage that inventory, what do you need? Forget about cash. No, the cash is in your bank account. That's doing nothing except earning you some interest, okay? That's a separate amount. You don't need to worry about at all. We are not talking about that. Working capital is about the inventory, and then to be able to have this inventory, what do you need? You need to buy some stuff on credit, which is accounts payable, and you need to sell this guy on credit, which is your accounts receivable. So working capital amount, okay, which should be proportionate to your sales amount, right? Because you need to have some inventory turnover, okay, to sustain maybe 1 month of sales you want to take care with your existing inventory amount, right? For this working capital purpose, the computation is like AR plus inventory minus AP. That's working capital. Only 3 items to worry about, nothing more. The rest of the miscellaneous items in current liabilities, current assets, forget about it. Okay, that's it. Right. Increase in working capital ties up company's cash flow. What do you mean? Well, increase your inventory sucks up your cash. To place some stuff on the shelf, you must have spent some cash for that part. It's a drainage of cash. On the other hand, if you reduced inventory, you must have liquidated it so that the cash balance must have gone up. Okay, so related to cash, free cash flow, okay, there is some relation going on, negative relation going on. Increase in working capital reduces free cash flow. Decrease in working capital increases your free cash flow going into the future. Makes sense, right? So that's the thing. Taxes and interest obligations are deducted. Of course, you need to say bye-bye to the government. Don't bother me. I'm a good citizen. Debt repayment may be fully or partially financed by issuance of new debt, which is treated as a cash inflow, right? This is the cash flow available to be paid out as dividend, okay? Now, reinvestment, okay? Capital expenditure is for long run, to support your long run sales, 20 years down the road. Change in working capital, okay? Change in non-cash working capital. This is to support your short-term sales, okay? I labeled the full spell. I spelled out the full thing: non-cash working capital. Okay, whether you call it this way or just working capital, it does not matter to me. Okay, WC means working capital, and AR plus inventory minus AP. That's it. Okay, the stuff on the shelf to do day-to-day sales, day-to-day business kind of things. Working capital defined. What is important is not just working capital, but the change from last year to this year. Okay, so delta WC is shown, which is WC sub T minus WC sub T minus 1. That should be WC delta sub T. Okay, I should have said sub T. Okay, this is awfully confusing. Okay, this is a point where many of the marketing people give up and say, you finance guy, you take care of it. You accounting CPA, you take care of it. Let me tell you one thing. In your I-Corp business, right, I-Corp case study, don't trust accountant. Okay, I'm sorry to CPA guys, but they have some serious lack of creativity. There's a problem about it. They are just black and white person. Okay? So much so that they cannot catch up with marketing guys' creativity. They don't know how to, and then you will be, they don't know how to incorporate your creative thoughts into the finance projection. Okay? Rather, the marketing guys may have better finance sense, which will be opening up your eyes. What? Marketing guys can be a good finance guys? Yes. My marketing friends back in Yonsei University, right? And I belong to a marketing club called the MARP, right? You go ahead, find it out in your website, internet, or Facebook, right? MARP, all-round players. And more than half of my marketing friends over here ended up in investment banking, and some of them are working for private equity because they are using this creativity with numbers. Okay, so that adds to finance. So if you believe you are a marketing guy or strategy guy, perhaps you're a finance guy as well. Okay, so go ahead and do it. Okay, yeah, awfully confusing, but don't lose thread. Okay, 정신줄 놓지 말고, just in Korean terminology, build up your Excel spreadsheet, obtain the change from last year to this year. That's going to be the affecting your free cash flow. So that's it.